Hello and welcome to the Killik & Co market update. This week we have seen a partial recovery in many markets following the turbulent volatility we had last week. Last week a number of global indices fell into official correction territory, which means they were down more than 10%. But this week we have seen a few buys coming in and markets have started to rise again. As you can see here, I've got a chart of the FTSE 100. So you can see last week we did have a fairly significant fall, but you can see that has started to go up again. So that shows that some confidence has returned to the market. And at the moment I think the general consensus is that what happened last week was really a short-term adjustment rather than the start of a long-term market decline. So obviously we are continuing to watch it very closely, but for the time being we are not overly concerned. Now, I know that many times over the last few weeks I have talked about rising interest rates and rising bond yields, but I am just going to mention it one more time because we have seen bond yields in the US rising to another significant level. So we have seen Treasury yields in the US rising to 2.93%, which is the highest level they've been for 4 years, so that's the highest level since 2014. So I think that is quite significant, and actually the 3% level is seen as a very important technical level, so I think it's important to be aware that we are not very far from that level. Now, over the last few weeks, I have mentioned a number of negative consequences of higher interest rates. The main one is that it is more expensive for companies to raise cash, to borrow money and to expand. But there are actually some positive consequences of higher interest rates as well. And one of those is the impact on final salary pension deficits. Now, over the last few years, there have been many concerns raised about the high level of pension deficits for final salary pension schemes. So particularly in the UK, we do have a number of firms who have long-term commitments to final salary pension scheme members who were former employees. And most of these firms will have a pension pot set aside. That money in the pot will be invested, normally into government bonds, and the income from those bonds will be used to pay the former employees. Now, because over the last few years we have had such low bond yields, the income coming from the pension pot has not been sufficient to cover the liabilities. So that's meant that a number of companies have fallen into deficit and they have been having to top up their pension pots. And actually a report was released last year to say that a number of companies within the FTSE 100 had final salary pension liabilities that were actually larger than the market capitalisation of those companies. And I've got a few examples of those companies for you here. So we've got First Group, the travel company, RBS, the global bank, IAG, which is the company that owns British Airways, and also defence company BAE Systems. So it has been a concern for quite some time now that these companies have had such high deficits. But now that bond yields are starting to rise, we have seen quite a notable reduction in those deficits. And actually the UK's Pension Protection Fund did release a statement last week saying that final salary deficits in the UK are currently at the lowest level they've been at since 2014. So that's definitely a good thing. And last of all, we've been looking at the Premier League TV rights, which are being auctioned off this week. And as yet, it doesn't look as though the prices paid for these rights will be quite as high as the astronomical prices that were paid during the last round of auctions. So have a look at this chart here, which shows the costs of the TV rights over the last few years. So as you can see, there was a huge step up in the cost paid for the rights for the 2016 to 2019 games. And that's when BT really stepped onto the scene and became a major contender for these TV rights, and that really pushed up the prices. But this year they have actually come down a bit. So auctions have been taking place this week between BT and Sky. So far £4.4 billion have been spent on the rights. There are still 2 small packages of games to go, but it's not thought that those will fetch a high enough price to push the total cost of rights over the £5.1 billion that was achieved last time around. Now, of these 2 packages that are still to go, there is a lot of speculation that perhaps one of the big tech companies like Netflix or Amazon will come in to bid. So that would potentially be good because it would break up the duopoly for rights that we have seen between BT and Sky over the last few years. But it would mean that for serious football fans who want to watch every match, they would now have to sign up to 3 different platforms rather than the current 2. So definitely something to keep an eye on there. Now, moving on to the week ahead, we do have a number of companies reporting. It is quite a big week for the miners, so we will be looking forward to results from BHP Billiton and Glencore, and also for banks in the UK. We've got HSBC and Lloyds Bank and Barclays reporting. That's it from us. Have a great weekend, and we'll see you next Friday.